Hello and welcome to the quarterly market update for Q2 2025. I'm Hannah Kennedy and I'm joined by Dr. Scott Osborne. So Scott, the first question I have for you today, it was just over a month when we sat down in our Liverpool office, and it was the day after Liberation Day, and Donald Trump had announced all his tariffs and he had the big signs, and we covered everything that happened then. It was just over a month ago, but a lot has actually changed since then. I wonder if you could tell me about it.
Yeah, wow. It seems like a long time ago. How long have we got? I guess, obviously the main thing is basically that the tariffs were paused. So the boards that you talked about, the big pictures with the list of all the tariffs, that's at least for 90 days it's paused. So in theory, we have until around the 8th of July before those tariffs are actually enacted. And there were some other little ones around the edges with automobiles and steel and stuff, and different things have happened. But the big relief point was when he came to the market and said, actually, we're pausing this, and there was a big relief rally. Now, the exception to that was China, and we did see some further developments on that. And the premise for this really was that countries that hadn't retaliated to that initial announcement, so they hadn't themselves, imposed some retaliatory tariff on the US, they were allowed to have this 90-day exemption. Whereas China, because it immediately retaliated, they got into this kind of tit for tat. And we subsequently got sort of back and forth, tariffs increase higher and higher and higher, until the point where we are now, which basically it doesn't really matter what the tariff is because it's almost an embargo. It's so expensive to send things either way that they just won't trade. But aside from China, and there's some positive noises there as well that they're going into some trade negotiations. The general big idea for the market now is that we have this 90-day period for countries on an individual basis to cut a deal with the states. And this has always been Trump's thing. He's a deal maker. He likes deals. Each country or whatever, the business within a sector is going to the White House and trying to basically get an exemption, carve out deal for the economy or business line or whatever. And that's basically where we are, that we're going to see these deals come through. And, depending on how many are signed or not, when we get to the 90 days, either things are sorted out or actually it still looks like a bit of a cliff edge. And it seems like where we sit today, the first of these is going to be announced even today or tomorrow, which is a UK-US trade deal. And that's probably one of the least important ones, right? Because we were already at the base level 10% tariffs. And for what it's worth, it seems like 10% for everybody is definitely going to happen. So the penguins on the herd of McDonald Islands are still going to get their 10% tariff, even if they wanted to cut a deal. But these different industries and stuff, it sounds like the first deal's coming with the UK. And then hopefully we'll see more after that. And the markets will respond to that. But that's the big... Obviously, Trump's done lots of other stuff in the interim as well, and anything he does or tweets or says or on any given day can make material difference. So we're just kind of living in that world. But the big picture stuff since the last time we had the tariffs announced, the tariffs were paused, now we're in this deal-making phase until around the 8th of July, on or around the 8th of July, and we're basically in wait-and-see mode what happens with these individual trade deals that they're negotiating.
Okay, brilliant. So that covers what happened with the tariffs, but what happened in markets?
Well, yeah, as you can imagine, there was a huge relief rally on the announcement of the pause. And it's all, we can pick through the bones of this about who knew and who didn't know, and it's all a bit shady in terms of moving the markets in material ways and front running it, etc. But essentially, there was just a massive relief at the point when they announced it. The intraday move, so not necessarily if you looked at the start of the day and the end of the day, but where it was in the move, because the markets were down, US markets were down earlier in the day. Then the tariff announcement came. They finished the day very handily up. It was 6-7% or more even on the day. And that's just an absolutely ginormous move for, you're talking trillions of pounds worth of value in seconds. So, and then obviously subsequent to that, we had all the China stuff that I mentioned and some other things that he wobbled the markets with, like he threatened to sack Jay Powell, the chairman of the Federal Reserve. Markets didn't like that. He immediately rode back on it. But generally, since the actual announcement and the market bottom, the markets have trended upwards. They're still not kind of back where they were necessarily. Certainly not since the start of the year, because there was some negativity even prior to that. But the trajectory has been upwards. Probably the biggest factor, and again, we can argue and people would debate this and history might take a different view or whatever, but it feels like one of the key reasons that the Trump administration capitulated was because of bond yields. And essentially we saw this dynamic in the US where the US equity market was down, so stocks were losing money, which is obviously not good for them and their popularity. But US bonds were also falling in value. And that's not what's supposed to happen. If stocks are down, bonds are supposed to be up. And basically there was this feeling that actually the global markets might be losing faith in the US bond market. And that was a serious worry. Combined with dollar weakness, which has continued, so people were also selling the dollar, they were selling US Treasury assets, and they were selling US equity markets. That put the sort of the worries in the US administration. And I think Trump on the day after they announced this pause, he said some people had the yips or the yippies, I think he said, but basically some people were worried sufficiently about this that they knew they needed to react. And that provided a little bit of support for markets, because markets have started to believe actually Trump doesn't care about us and our investments generally. He's just going to do what he wants to do. It's this idea that the markets would act as a brake on Trump. People had started to abandon that, and it felt like, oh, actually no, there is a level where he will listen to reason. So you had the big drop from the announcement and then a recovery. And that's basically where we've continued. The trajectory has been upward. Obviously, the US was the worst impacted, so the US is still the worst market year to date. The UK and Europe have done relatively better year to date. In fact, Europe's done very well. But since this sort of announcements, basically nowhere has actually made money. The negativity that was at the start of the year was centered on the US. Other markets were okay. The negativity subsequent to tariffs has been for everybody. It's just the US has been the worst affected. And you've basically seen the flip side of that as the pause has come off. So again, in terms of the trade deals I mentioned, we're kind of in limbo. It's similar on markets because these trade deals will have a material impact on growth, etc. So it's a kind of wait and see mode. But certainly the initial overreaction to the announcement and everything has washed out to a certain degree by now. Yeah.
Brilliant, thanks, Scott. So that covers what's happened with these trade tariffs and what's happening at the moment, what happened with markets. Now, our clients who may be invested in the VT Astute funds will be wondering, on the way down or on the way up for markets, did we make any changes to the funds?
Good question. And the answer is no. In fact, the answer is a resolute no. And we're actually pretty pleased that we managed to not do anything. I think you've heard me say on loads of videos now, probably in the past, that our approach to Trump was to react but not overreact. And the biggest risk in these types of environments is that you make a decision in the very heated moments where you're not really thinking rationally, or you're responding to very sort of short-term news and not knowing what's going to happen. And it's very difficult to make good decisions in those circumstances, and which is why we'd kind of give ourselves this mantra in advance to react but not overreact. And at no point did we think actually that we'd found a sufficient sort of base or sensible, quiet moment, a bit of rational sort of space to make a good decision. We did at one point at the very low start to think, okay, equities have fallen enough here that we might want to consider selling some of our bonds and buying some equities, which is what you do at the bottom. But that literally by the time we'd come to that decision, the markets were already rebounding. So I think if anything, we feel justified in our decision making that we didn't do anything here, because we've seen exactly what we thought we'd see, which is a huge overreaction. That overreaction unwind, or not all of it, but most of it, as kind of markets respond to things which are temporary. And we'd always said this with Trump, that you can't really take what he does at face value. It might be the direction of travel, but he can take it away the next day. So yeah, we didn't do anything, and we feel quite good about that, because the temptation to do something in those environments is very high, and I think that's when mistakes are made. It's the classic, don't just do something, stand there. It's quite hard to do that, and our portfolio was well set up for that scenario. We had confidence in it. We stood by a portfolio. It acted in the way that we wanted it to act, and we avoided making bad decisions, which I think is the sort of main priority in those types of environments.
Brilliant. So we're constantly assessing the portfolios, and as we're constantly assessing them, the decision so far has been that the right thing to do is not to do anything at all. What is the assessment as we stand today?
Yes, well, everything I said there is kind of, we're pleased with how we did, but that's the key question now. The key question is, at what point is it right to make a move? And we feel like we're getting there now. Like the whole don't overreact but do react, we now believe we're in the reaction phase. We've had the initial overreaction, we've had the escalate to de-escalate, the tariffs and all the sort of art of the deal nonsense. Now we're in a position where we can say, okay, we've got enough information to make a rational decision about what the near future looks like. And that's what we'll be basing our decisions on, the near future. And whilst we've not got anything, on the block as it was to do now, before the 8th of July deadline, as you were, before this 90 days, we think there's a window there where you can reposition for how you think things will pan out. And where we sit today, what we believe is that there is still quite a lot of bad news from everything that's happened that's accumulated, which isn't really fully appreciated by the market. And that's because of this overreaction sort of function, really, is that people saw the tariffs as negative, they saw the markets drop, and then the tariffs were paused, so the markets recovered, and then they looked at the economic data. So we've had jobs numbers out the US. We've had a slightly misleading GDP number. It said the US economy shrank in Q1, but it didn't really. It was this sort of import effect because of tariffs. But fundamentally, the hard data still looks pretty robust in the US if you look where we sit today. And I think markets have kind of taken solace from that. And that's a mistake in our view, because I think a lot of the problems that have been created here, a lot of the issues are being saved up for the future, and we will only really see their impact later in the year. So for us, if you look back 6 months and you had a view on the US economy, your view today versus then is probably slightly more negative than it was, or at least certainly our view is. And that's the basis for which we'll be making some of our decisions, I think. Probably more important than that, though, and key to any decisions that we make, will be diversification. We were able to not do anything in this period. We were able to sit on our hands safely and secure in our portfolio because we know we'd done the work in advance on diversification. We didn't see the funds reacting in a way that we didn't expect. We saw bonds do well, we saw equities do badly, that's fine. We have the diversification benefit. But we have seen a lot of correlation between things, so things moving in the same direction simply because Trump's impact has been so dominating. It's like the center of gravity for the whole investment universe, and with a single tweet he can move the entire universe around. And that's quite uncomfortable because it reduces the level of diversification. So one of the things we really are focusing on and trying to push our research towards is, okay, where are the ideas that will diversify away that Trump risk, if there are any? Is there areas of the market that will do what they should do independently of what Trump tweets or whatever puts out on Truth Social? And those will be the very attractive areas. And so the combination of those will be what drives our decision making in the near future. And I think that slight deterioration in the global growth picture, I think that's generally shared. Like we've seen central banks report, we saw the US Federal Reserve yesterday, as we speak today, talked about a higher risk to unemployment, which basically means recession in the US. We saw the Bank of England cut rates today, and although they weren't too pessimistic, they've downgraded their own GDP forecast. So I think generally there is a sort of view that growth might be subdued somewhat, and we'll have to respond to that. But again, our focus on risk-adjusted returns and delivering for what our clients want in terms of cash flow and their longer-term objectives, what we're really searching for is good diversification that will help us get through this difficult period where things just move around on what Donald Trump decides when he wakes up in the morning. So yeah, it's been interesting, and it's going to stay interesting basically. But we do think we're in that phase now where the initial dust has settled a little bit, and we can actually start allocating and making firm decisions, and so those will be coming down the road in the next few weeks, I expect.
Brilliant. Thanks for that, Scott. And thank you for watching. That's all we've got time for today, but if you have any questions, then please get in touch with your financial planner. If you're new to Astute, then you'll find a link that will sit below this YouTube video where you can get in touch with us. We'll see you next time.